Principles of Finance with Excel Modeling, copyright Lou Gaddis. Topic 9, Financial Risk Management, Mitigation of Financial Derivative Contracts. Benninga's Chapter 20 provides a nice introduction to options, and Chapter 21 describes the Black-Scholes model in much more detail than we will. So in this topic, we're going to use the IMM Risk Management Framework, identify, measure, mitigate to discuss mitigation strategies, understand how forward option contracts be used to hedge cash flow risk, value options using Black-Scholes option pricing model, and we're going to start this topic or continue this topic using our example introduced in topic 8 and then in topic 8a on the Hoffman gold mines. So let's talk about the IMM risk management process again. The first step into managing risks is to first identify what we're exposed to. And the example we've been using for the last couple of topics is the Hoffman gold mine. In that example, they're exposed to increases in fuel prices, decreases in gold prices, decreases in gold per acre or per ton of dirt, and exposed to, say, a short summer season. So once we've identified our exposures, the next step is to measure them. And in topic 8, we did worst and best case, hypothetical, and historical scenarios. We did data tables, we did some break-even analysis, and in the prior topic, we even did earnings at risk, and we did a simulation. So these would be stochastic models. Now we're going to talk about mitigating the risks. We've already talked about this a little bit. Once you've identified and measured all your risks, the next step is you might decide just to accept the risk. In other words, do nothing. And that might be because it's just immaterial or just you can't hedge the risk for whatever reason. You could also decide to lay off the risk. In other words, just cease or delay operations. The next one is you can decide to hedge the risk. Now that can be done with just a normal insurance contract, right? If you're exposed to, say, breaking down equipment, you can buy an insurance contract or a maintenance contract for your equipment. Or you can do a business solution, and we talked about this last topic. If you're exposed to a low gold content in the ground, you can do core samples, and that can reduce that risk. You know exactly how much gold you have before you go in. And then the next, and then related to that is something we haven't talked about yet. Another way to hedge the risk is use financial derivative contracts. And what we're going to talk about is the use of forward contracts and option contracts to hedge risk. And lastly, once you've either accepted the risk or hedged the risk, you see what risk is left over. And the last thing you might want to do is just hold capital. In other words, if you measured that we might lose, say, $200,000 in our worst case scenario, maybe one solution is maybe not even hedge any of the risk. Just make sure you hold $200,000 in cash reserves. That way the business will not be interrupted or go bankrupt. And here's the analysis we did in topic 8. We did our base case analysis all the way down to free cash flows. We did our worst and best case, looking at all the things that can go wrong or all the things that go right. And we think this is the true range and the truly worst case and truly best case. We did a global boom hypothetical, and a global boom, we think gold prices are down and fuel prices are up. I did a historical scenario. In 1981 was a particularly bad year for gold. Gold was down 25%. And that year also fuel prices were down 8%. And then I looked at a hypothetical environmental situation. What if we had a long winter? In other words, our season was really shortened. Everything else is the same. And therefore you have less than average free cash flow. So those scenarios, we can graph those and talk about, these are kind of the range and the possible outcomes that we have to worry about. And then we did some factor sensitivities. We looked at revenue, EBITDA, free cash flows, as gold was up and down 20%. And you can see when gold is down, our profits are down too, and our revenue and our free cash flows. And then we did a two-factor data table, varying gold content per ton and varying gold appreciation. And you can see our best scenarios are when there's lots of gold and gold prices are up. Worst scenarios, little gold and gold prices are down. And then we did some break-even analysis. The break-even is we found that we need at least 0.17 ounces of gold. And that's why we want to do those core samples, right? You're not going to actually even dig up the ground unless you can find 0.17 ounces. Our break-even depreciation of gold is negative 29%. So as long as gold doesn't go down by more than 29% and our quantities are held constant, we'll break even on free cash flows. And lastly, our diesel fuel prices can go up 188% before they make our cash flows go zero. And then topic 8A, if we did that topic this semester or this mod, we did an earnings at risk number. We calculate the 95% confidence interval earnings at risk, and we just on our gold, so that's a gold only EAR, earnings at risk number, or cash flow at risk number. And that said, if we assume that gold appreciations are normally distributed with a mean of 2% appreciation and a standard deviation, I believe we use 25%, the 95% confidence interval EAR is $155,000. In other words, we're 95% confident that our cash flows will not be $155,000 less than the expected of 188. Or the other way of looking at that is there's a 5% chance our cash flows will be $155,000 less than expected. And then on topic 8A, we also did a Monte Carlo simulation. Again, these results here are assuming that gold returns are normally distributed. We then used a Monte Carlo simulation. We made gold appreciations a random variable, generated 10,000 possible scenarios next year with gold prices, and we found the average of 119, which makes sense. You should get back to the base case, especially since normal distributions have a symmetric pattern. And then we found out the 5% lowest and the 5% highest cash flows. And then we also calculate, well, what percentage of the time should we expect negative cash flows? About 10%. And what percentage of time are we expecting lots of big cash flows, say greater than $250,000? That was 8.7%. So that's what we did in topics 8 and 8A. Now we're going to talk about a way to hedge the risk, and that is using derivative contracts, specifically forwards and options, but I'll also mention swaps. So let's talk about what a derivative contract means. A derivative contract is just a financial contract, and the reason why it's called a derivative has nothing to do with math. It just means that the value of the contract is derived from an underlying underlying asset. So in other words, we're going to do some gold derivative contracts, which means the value of the contract depends on the price of gold. So the first contract we're going to talk about is a forward contract. A forward contract is an obligation to buy or sell an asset at an agreed upon price, place, time, quality. So you're going to fix all those terms, including the price, and you're going to enter into a contract to say buy or sell, in this case gold, at what we call the forward price, whatever the price you agree to. Now, so for example, what we're going to do is we're going to do a gold forward contract for Hoffman Mines. So what Todd Hoffman's going to do, he's going to enter into a contract to sell his expected quantity of gold, 337.5 ounces, at a forward price of $16.32, and he's going to try to negotiate that. Since our $16.32, we'll call that the expected price next year. Todd should be able to find someone to have an agreement to buy all his gold for $337. In that case, he has now a forward contract on gold, and he no longer has risks. Now, forward contracts generally have no upfront cost or fees. It's really just a contract in which there are two counterparties. All right, the seller, in this case, that would be Todd Hoffman, also called the short party. The seller of the contract, meaning in the contract, the contract specifies the seller will deliver gold and the buyer will accept gold at the forward price. In that case, Todd will sign his name next to the spot where it says seller, also called the short party. And then the buyer could be anyone. You can think of the buyer being maybe a jeweler that wants to lock into the price of gold. Now the buyer also signs this contract, and what the buyer will do is take delivery and pay the forward price in 1 year in this case. Now I'll just mention swap contracts. A swap contract is simply a bundling of forwards. In other words, Todd Hoffman, instead of maybe having a 1 year contract, could bundle 12 1-month contracts and promise to deliver, say, 10 ounces of gold every month for the next 12 months. All right, so we're not going to cover swaps, but let's just say that they're a bundling of forward contracts. And the last thing we're going to talk about, the last part of this topic, is option contracts. Options are a lot like forwards. They specify a price and a quantity and a maturity date. However, the difference is when you enter into an option contract, just like the name implies, you have the option to walk away. So Todd could buy a call option. That's the right but not obligation. Todd's going to get a put option. Let's forget that. Todd's going to get a put option for the right but not the obligation to sell gold at in this case, we don't call it the forward price anymore. We call it the exercise price and also called the strike price. So Todd will buy a put option. He'll have to pay an upfront cost. We call it the option premium or option cost. And then Todd will have a contract that gives him the right to sell his gold at that agreed upon price. But he could always walk away if he can get a better price. On the other hand, a jeweler could get a call option, and that would be an option to buy gold at a fixed price. So let's talk a little more about these contracts and the actual delivery. Now, this is going to be a little bit strange to kind of talk about this, but let's start. A contract to buy gold, you would think that it would have at the maturity date, Todd Hoffman would deliver gold to the counterparty of the forward contract, and then the forward party will pay him. Well, that's normally how they're structured. That's called physical delivery. However, what I'm going to do is talk about another type of contract that could be negotiated, and that would be a cash settlement or a financial settlement contract. But we'll get there in a second. So let's do a simple example. There's a miner that enters into a forward contract to sell 100 ounces of gold, that's my quantity, at a price of $1,200 in 1 year. We'll call that the forward price. And now, all right, so that's what they expect. They enter into a contract to sell their expected gold of 100 ounces at $1,200 an ounce. And the reason why the miner does this is she fears the price will decline in 1 year, so she wants to lock into that $1,200. Now, let's just pretend today they sign the contract, and she is now locked into delivering 100 ounces at $1,200. And what if 1 year from now, the actual price of gold in 1 year is $1,000? Now, if the miner had not hedged, she'd sell her 100 ounces of gold for $1,000, the price next year, and she'd receive $100,000. But this miner had some forethought. She locked into a forward price of $1,200, and if that contract specified physical delivery, she would then deliver 100 ounces of gold, get the forward to the counterparty. The counterparty would then, the buyer and the counterparty would then give her $1,200 an ounce for $120,000. So this is the benefit of a forward contract. No matter what happens to the price of gold, this miner is guaranteed a cash flow revenue of $120,000. We'll call that pre-tax. Now let's talk about this weird concept. What if the contract didn't actually specify delivery? All right. And what if it just said that we're going to have a contract where the seller, in this case our miner, agrees to pay or receive this cash flow? And what is this cash flow? Well, this cash flow is whatever the forward price is. In this case was our $1,200 minus whatever the spot price is a year from now. You got to wait now and see wait a year and see what it is, times a negotiated quantity, and we'll just negotiate $100, and we'll negotiate a forward price of $1,200. So now it's really a contract. This exchanges cash, and the amount of cash is derived from the price of gold. So what if the miner signs up for this contract, and gold is selling for $1,000 next year? Well, let's see what happens. Well, the miner has this forward contract that specifies a payment of the forward price minus whatever gold is selling for next year, in this case $1,000, times whatever quantity you negotiate. So in this case, the miner is going to just receive a check for $20,000. So now the buyer has a check for $20,000, but the contract doesn't specify delivery. So now the miner just goes and sells her gold at the current market price a year from now, which is only $1,000, and receives $1,000 for her gold. However, she got a $20,000 check from the counterparty of the forward contract, which means when you add those two numbers together, she now has $120,000, $20,000 from the forward contract payoff, and $100,000 for the sale of gold in the spot market. In other words, if you look at these two numbers, it appears that it doesn't matter whether the contract specifies delivery or specifies a cash settlement. The net effect for the buyer and the seller is the same. They are going to receive $120,000, in this case the miner, for the gold. And I could also prove that the the buyer, in this case, say the jeweler, if you want to think of them that way, will pay exactly $120,000 for the gold also. Now, for the buyer, the payoff is just a little bit different. Just change the two location, instead of forward minus spot, it's just the spot minus forward. So in this case, the jeweler winds up paying $20,000. And then she goes ahead and buys the gold in the spot market for $100,000. So she has locked into a cost of $120,000 also. So in this case, both the buyer and seller have eliminated the price risk of gold without actually exchanging gold. Now, why would anyone want a contract like that? Well, it's just much easier to buy and sell gold where you normally buy and sell gold, and negotiate a forward contract that just pays you if the price of gold goes up or down. Now think about, you don't really know the jeweler. You just find, through an intermediary, say Goldman Sachs in New York, they pair you together with a firm that's trying to buy gold. And therefore, you really don't want to deliver gold to, say, New York City. You just want to get a check from Goldman Sachs, who acts as an intermediary in this case. And you just go ahead and sell gold where you normally sell gold. Now, the reason I'm talking about this is most contracts actually are forward settlement. I'm sorry, our physical delivery. However, by thinking about these contracts as cash settlement, it's going to generate the exact same forecasted cash flow. And it just so happens that modeling the contracts as if they were cash settlement is so much easier to do in a model to assess the risk. And that's what we're going to do. We're going to put that formula in. So again, if Todd Hoffman were to enter into a forward contract to sell his anticipated 337.5 ounces of gold, that's what he expects to mine next year, and he negotiates a forward price of $1,632 an ounce. And we'll just pretend it's a cash settlement contract, because it doesn't really matter whether it's physical or cash settlement. The net effect's the same. So that's as if thinking about Todd has this cash settlement contract whose payoff is the forward price $1,632 minus whatever the price turns out to be next year times 337.5. So what we're going to do is we're going to enter that into our model, and we're going to see how that affects our model. So I'm going to go to our Excel file. Got our scenarios here, and I added a little row here. It says derivative contract payoff. That's between revenue and cost, so we're going to get the tax shield on anything we wind up putting in here. And what I'm going to say is, let's pretend Todd has just entered into a contract where he has a forward contract to sell gold at $1,632. However, it's going to be a cash settlement contract, so he's going to pay the difference between $1,632 and then whatever the spot price turns out to be. And that could be, say, $1,600 or $900 or $2,200 or $1,400. So whatever it turns out to be. So I'm going to multiply that times my quantity of 337.5. So again, the reason why I'm hard coding these, the contract specifies a forward contract of $1,632 and specifies a quantity of 337.5. So in this situation right here, the payoff is 0, because in this scenario, my base case is gold prices actually turn out to be $1,632. But let's carry it over here. In this situation here, Todd is going to get a payoff from, say, the jeweler or the Goldman Sachs, or wherever arranged this contract. Actually could be an exchange, say the Chicago Mercantile Exchange or the New York Mercantile Exchange, the NYMEX. But in this case, if gold prices do fall to $960, it was in this scenario, I take the difference between my $1,632 and my $960 times 337, and Todd will get a check mailed to him for $226,000. So if I copy this across, this is now the payoffs of the forward contract. If gold prices are $1,600, $960, $2,200, $1,400, $1,100, and $1,600. Notice anytime gold is down, Todd gets paid and things get better, right? This worst case isn't as bad as it used to be. And anytime gold prices go up, Todd pays. So in this case, gold prices go way up, so Todd has to pay. Now, that's not good for Todd, and what that means is his worst case isn't as bad, and his best case isn't as good. However, by definition, that's reducing his exposure. Now, here's an interesting thing what I did here with the data table. Now, first of all, I'm gonna have a data table that takes the revenue and adds the payoff right here. I'm going to add these two numbers together, and let's do a data table and see what happens as gold prices vary. So I'm going to look at the revenue plus that derivative payoff, and look what happens. I'm going to do this data table where I'm varying gold prices from negative 20% to 20%. And notice if I keep the quantity the same, all right, no quantity risk. There's no change in quantity. I will always get $550,800 for my gold, selling it into the spot market and then getting a payoff from the forward contract. And EBITDA is always the same, and free cash flows are always the same. And then I do it here. I have a two-factor data table where we have gold prices changing and gold content in the ground changing. So this is actually the amount of gold I'm mining. Notice if I have this 0.25 ounces of gold is what it takes to get 337 ounces in total mined. And notice as long as I deliver that 0.25 ounces, or as long as I the 0.25 ounces of gold per ton and get that 337 quantity, I have no exposure to gold prices, just like the above numbers. However, notice here in this example, I'm mining a lot more gold than 337 ounces. So what you see is my risk does not go away. It's small, right? Because I'm only my free cash flows are going from 300,000 to 391. But what's going on here is you can think about how we've modeled it. If I get more gold, I'm going to sell all my gold at the spot market. However, I have a forward contract that pays me the difference between the forward price and the spot price times only 337 ounces. So in effect, I haven't really hedged all my gold if I actually have more than 337 ounces. And in this example, I've actually I've dug up less than 337 ounces. However, so my payoffs on the gold contract are still fixed at 337 ounces. Now, the quantity to pick. So the question is, what if there is variability in gold content? Well, what you should do if you want to minimize the actual variance and risk of my cash flows, you should choose a forward contract quantity equal to your expected gold content. All right. So even though in this case we actually don't even have enough gold to deliver, that's okay. You know, it's a cash settlement contract. We just had to make a check, pay a check or receive a check that's based on a different quantity. That's okay. Or if it were a physical delivery contract, it's still okay, right? In this example here, we didn't actually mine 337 ounces. But if we had to deliver it, that's okay. We just go out and buy it in the spot market and deliver it at the spot price. I'm sorry, at the forward price. All right, so it's okay to not have the exact amount of gold at maturity of the contract. If it's a cash settlement contract, it doesn't even matter. It's just a formula. And if it's a physical delivery and you had to deliver more gold than you mined, you go out and buy it. And then lastly, we'll look at our break-even analysis. What changes is we no longer, as long as the quantity risk is the same, or there's no quantity risk, we no longer are exposed to gold appreciation. So that's how we're going to model the fact that Todd Hoffman just entered into a forward contract to sell all his expected gold at $1,632 an ounce. And if you compared, say, the unhedged risks and scenarios, what you see is the risk is getting smaller, right? These scales are a little bit different. There's 600 and this 100, but what you see is all the risks are getting closer to zero. In other words, the good times aren't so good and the bad times aren't so bad, right? We've gotten rid of this really bad time right here. And these times where cash flows are much lower, they're more even. So that's what risk management's doing. And what's interesting here, again, is we no longer are exposed to gold prices as long as the quantities are the same. And even if quantities are different, this is still less risky. All right. And the last thing I did is if we had topic 8A in this mod or this semester, sometimes we don't get to it. In that case, we ran simulations in topic 8A, and if you'd like to go to YouTube, if we didn't get to it, you can take a look at it. And what we did in topic 8A is showed that free cash flows have a wide dispersion based on gold appreciations if we assume that gold prices are normally distributed and randomly generated. However, I reran the simulation, and what I added was that formula pretending that Todd bought that forward contract. And when I ran the simulation with this payoff of the derivative contract, 1632 minus the spot price, whatever the random spot, this is the random spot price. It turns out that every one of those 10,000 Monte Carlo simulation values, every change in gold was perfectly offset by a cash flow from the forward contract. And all of the 10,000 iterations turned out to be exactly 118,897. So I went from a risk that looked like this to a situation where I know exactly my cash flow as long as the quantity is the same. So let's talk about the last topic here, and that is option contracts. An option contract looks a lot like a forward contract. An option contract is the right to buy or sell an asset in the future. However, is an option. It's very aptly named. It's an option. In other words, you have the right to buy or sell, but not the obligation. You can walk away. So a call option is the right but not obligation to buy an asset, say gold. What Todd wants is a put option, the right but not obligation to sell an asset. So the difference between the forwards and options is the option contract is not an obligation. However, for the party that buys the contract. So what does that mean? Unlike a forward contract, both parties sign the contract. No one exchanges any cash at the beginning. They just agree upon delivering the asset and paying the forward price. However, if you have a call option, the buyer of the call option is an option to buy the asset in the future, but you can walk away from it. You have to pay a premium. You pay something upfront to the counterparty. And if you have a put option is a right but not obligation to sell. If you have that right to walk away, you have to pay for that right. You have to pay an upfront premium or cost. All right, now sellers of a commodity like gold miners and Todd Hoffman, what they want to buy are put options, an option to sell their commodity at a fixed price. All right, now they're only, and so when we talk about options, we talk about is do you exercise the option or don't you exercise the option? All right. Now again, I think I mentioned this before, but when we talk about a forward contract, the agreed upon price to buy or sell is called the forward price. When we talk about options, that agreed upon price, we just change the name. We call it the exercise price or the strike price. That's the price written in the contract. So if I owned a put option to sell gold, I am going to exercise that put option and sell my gold at that strike price, only if that strike price is greater than the current spot price. If that's the case, I'll exercise the option, call that counterparty and say, I'd like to exercise the option. I'm going to deliver the gold and please send me my strike price times the quantity. Otherwise, you just let the contract expire and there's no payoff. Similarly, the buyers of a commodity, like jewelers that want gold, they would purchase what we call a call option. And that gives them the right but not obligation to buy the commodity at the agreed upon strike or exercise price. And only if the strike price is low, like a cheaper price than the spot price in the market, you'd exercise the call option and buy the gold at that cheap strike price. Otherwise, you just buy it cheaper in the spot market. All right, last slide before we put this in the model and see what happens. Now, how do we model the fact that we have a put option or a call option on gold? Well, we have to handle two things. First of all, to buy an option, right, you have to pay someone to have this ability to walk away. Let's just pretend that this put option to sell gold is selling for $222.09 per ounce. And Todd wants a put option on 337 ounces of gold. That means that Todd is going to pay $74,955 today, all right, for this contract that gives him the right, but not obligation, to sell 337 ounces of gold at $16.32. We'll call that the strike price in 1 year. All right, so what we need to do to model this is we're going to first subtract the option cost, also called the premium. All right, and that's going to be the $220 an ounce times the 337.5 ounces. And then we're going to handle the exercise value or the payoff. So what is the exercise value or payoff of the option? We'll just call it the payoff. So that's the value of the option at maturity, and that's how we can think of this as just like the cash settlement value. Now, once you own an option, if you choose not to exercise, the payoff is 0. You walk away and you just lost your premium. However, if you choose to exercise your option, it'll either be the strike price, well, we'll just call that X, minus the spot price. All right, and that's going to be the case of a put option, or it's going to be the spot price at maturity, the spot price next year, minus the strike, which is going to be for the call. So how we're going to model that in Excel is we're going to subtract out the cost of the option. That's going to happen no matter what happens. All right, you got to pay that no matter what. And then we're going to say the answer in the future is either going to be 0, or for a put, whatever the strike price, $16.32 minus whatever the spot price turns out to be. And how we model that in Excel is we assume that the exercise of the option is rational. In other words, you're only going to exercise the option if it has value. So what we're going to say is the payoff of the put option is the maximum of 0 or X minus the spot price. And if for a call option, I would say it's the maximum of either 0 or ST minus the strike. So let's go do that for Todd Hoffman. So let's go back to this model here, the scenarios. But now, in this area here, we're going to get rid of these formulas because that's modeling a forward contract. And we're going to say the first thing we do is we're going to subtract the $222.09 times 337.5 ounces. So Todd's going to pay $74,955 today. But in the future, Todd's either going to get, we'll just say max, we're either going to get 0 or $16.32, pretending it's cash settlement just for ease, minus the spot price times the negotiated quantity of 337.5. So why maximum? Because if we model a rational exercise decision by Todd, Todd will only exercise this option if it creates value for him. In other words, if 16.32 minus the spot price, that is the cash settlement value of the contract maturity. If that's negative, Todd should do nothing and just and so the cash flow would be 0, and then Todd would just buy gold in the spot market at a really, sell gold in the spot market at a really high price. So look what's happening right here. If gold turns out to be 16.32 and Todd has a contract to sell gold at 16.32, well, that's going to be 0. It's actually the maximum of 0 or 0. In that case, Todd's going to walk away and just sell his gold in the spot market. It's easier, but he lost that premium. Well, let's copy this right here. Here's a worst case scenario. Gold is selling at $960 an ounce. So how's this going to model the behavior? Todd still paid the premium, the cost of the option. That's that $75,000. However, Todd's going to exercise the contract, selling his gold at $16.32 and not $960. However, how we model that, we just pretend it was a cash settlement just for the modeling purposes. So it's as if his counterparty, the person he bought the put option from, sends him a check for the difference of 16.32 minus 960 times the 337 ounces. So after the premium, that means he gets a net check of 150. I'll copy this over, and these are all the payoffs and plus the profits or our cost of the option. And then you can see that what happens is my worst case isn't so bad because I get this check when gold prices fall. But my best case is still pretty good, because even if gold goes up, Todd still gets the high price of gold. So you can see it right here. Todd's still getting the high price of gold. He just lost that $75,000 because that premium, right, that ability to sell gold when prices go down. Now here's what's really interesting. If we look at these tables that got generated, Todd, no matter what happens to gold, if it falls anywhere below 1632, Todd's okay. Because worst case, Todd pays 1632 for gold, minus that $75,000 premium he paid. So no matter how gold prices go down, I'm going to say gold prices go down 95%, 99%. If gold prices go down 99%, Todd is still doing fine. Now, what if gold goes up 99%? Todd does awesome, right? Because that's the fact that if gold prices go up 99%, he's not going to exercise the option. He's going to sell the gold at the high price. So this is the normal payoff for an option. It provides some protection. In this case, it provided protection for Todd if prices go down. Now, for the jeweler, it's going to look the other way. The jeweler is locked into a cost, right? The jeweler is locking into buying gold. If a jeweler bought a call option, the jeweler would be locking into the cost to buy gold. And I can look down here and also see the same pattern. Now, if I did run the Monte Carlo simulation, you get a really interesting payoff. Right? If I don't hedge, I get this expected really good times and I get really bad times. If I get a forward contract, I basically only get one possible scenario, and that is I always sell my gold at 1632. However, if I get a put option, effectively every time gold goes down, Todd is locked in to selling it at 1632 and pays the $75,000 premium, which winds up being a total free cash flow after cost of $66,000. So that is the worst case. Notice the $66,000 shows up a lot of times. That's every single scenario where gold prices go down. By the way, here's how you come up with that $66,000. It's just the price of the contract, $74,955, plus selling my gold at 1632. So here's your payoffs with the put option. There are no bad times anymore. There are a lot of times where I do okay. Now, it's not as good as it was if I didn't hedge at all, because when I get 1632 for my gold, I still had to pay that $75,000 premium. But the good times, I got a lot of good times still. If gold goes way up, I'm still going to participate in the upside. Now let me just draw this and see if it makes sense to you. Let's pretend that this is if they don't hedge at all. So if they don't hedge, what I'm suggesting to you is the histogram used to look something like this. So why does it look the way it does? Because I've eliminated all my downside with the put option. However, the good times aren't quite as good. There's always this little gap. That little gap represents the $75,000 premium. So I had to give up a little bit of the good times to get rid of all of the bad times. So here's my choice if I want to hedge with a forward or a put. If I don't hedge, I have exposure. If I use a forward contract, as long as quantities don't vary, I always get the same amount. And if I get a put option, I get that same amount minus $75,000. Notice that this is a little lower than this. However, I still have some upside. Now, why would you do one or the other? Well, if I really was bearish on gold, I would probably just lock it down. Just get a forward contract. If I really felt gold was in a bubble, and actually at the time it was, I just get a forward contract and lock down the price of gold. If I thought that gold was more likely to go up, but I'm still nervous, I would probably buy a put. But if I really knew gold was going to go up, I probably just wouldn't hedge at all, right? Because I feel like that's not going to happen. So it really then comes to your belief in what's going to happen to gold prices. Are you bullish? Are you bearish? Do you think it's going to go up or go down? And what is your risk preferences? Do you want to sleep well at night knowing that you're going to lock into a certain profit on gold? And here's a little note on the pricing of option contracts. This is a formula for a call and a formula for a put to price options. This is the Black-Scholes option pricing model. All right, this is back in the early 1960s and 1970s. Two economists, applied mathematician types, developed this model to price options. The model has a few parameters. Those parameters are the current spot price, whatever you negotiate as the strike price of the option, whatever you negotiate as the maturity of the option in years, say 1 year, your expected standard deviation of the underlying appreciation of gold, or whatever this is, the risk-free rate for a 1 year maturity, and then if this were a stock, I put the stock's dividend yield. But since this is a commodity, gold, I'm not going to put anything in there. So what you see is there's 1, 2, 3, 4, 5, 6 parameters. All of them are pretty much known, right? You know the current spot price of gold. You can negotiate the forward, the strike price. You can negotiate the maturity. You know what treasury rates are. You know if it has any dividend yield. So the only thing you don't know is the annual standard deviation. Now, where did this model come from? This model was generated based on the idea that you can model the price of any asset, assuming that its changes are normally distributed and follow a random process. If you do that, they figured out the mathematics to compute the value. And this is a BS call, Black-Scholes call, and Black-Scholes put. I put those into my model. Again, the tricky part is forecasting what the standard deviation is. I could maybe just use last year's standard deviation or last 5 year standard deviation, or even use some more complex models that forecast standard deviation. But I just put that number in there and it tells me what a fair price would be based on the assumptions that gold prices appreciations are normally distributed. And that's where I got my $222.09 for a call. If I was trying to price a put, if I was trying to price a call, it would be 222.41. Why are they different? Well, the one way to think about it is assets are generally expected to appreciate, right? Over time, just due to inflation, risky assets are expected to appreciate. Therefore, a call would be a little more expensive than a put because the price is expected to go up. Now let's just talk a few more things. That is, think about Todd Hoffman also hedging fuel prices. There are not just forward contracts and option contracts on gold. There's contracts on stocks, bonds, every currency you can think of, precious metals, livestock, say cows or pigs, crops like corn and wheat, even crazy things like weather we'll talk about. And there's all fuels. You can get, say, diesel fuel or crude oil or heating oil. So you can enter into contracts to buy or sell any asset in the future. Now, why do I say weather? It's because contracts could be cash settled. Once they're cash settled, you no longer have to bet on anything that's actual physical. I could just have a forward contract that pays me if the average temperature, say in a particular city, is above or below some, we'll call it strike price, some agreed upon price. So you can basically set up contracts that bet on the temperatures, but we call those forward or option contracts. All right, now forward and option contracts, quotes, if you're looking for them, you just go to a mercantile exchange like the Chicago Mercantile Exchange or the NYMEX, New York Mercantile Exchange, or the London Exchange, and other banks, or go to Bloomberg, and you can get all kinds of quotes on the price of a call option, a put option, and what the current forward price is for gold for 1 year delivery. So if Todd wanted to hedge the purchase of fuel, he could enter into a forward contract to buy his fuel. He can also enter into a call option that guarantees the price of fuel, but he can walk away, but you need to pay an option to do that. How can we add this to our model? Well, we can just go back to our model, and right in here, we can just put the payoff of a call option or a forward contract in which they're buying fuel. So again, if it were fuel, I would just do the payoff of a long forward where I'm buying fuel, which would be ST minus the forward price. Or I can do a call option, where it's the maximum of 0. This the future maximum of 0, the future spot price minus the strike price. And also subtract out the premium. So I could just handle it in here if Todd Hoffman entered into a contract to buy fuel with an option or a forward. So again, risk mitigation. Once you've identified your exposures and measured them, you can decide to accept them, lay them off, hold capital, hedge using, say, insurance or core samples. But also you have this ability to use financial derivatives, contracts to buy or sell a commodity in the future. So in this topic, we talked about the IMM, risk management framework. We also talked about how to, we figured out how to use forward and option contracts to hedge a risk and how to model them. We talked briefly about valuing options using Black-Scholes option pricing model. And we did this whole exercise in the context of Hoffman's gold mine.